Welcome, everyone. I'm John Amodio. I'm chairman of SCORE Staten Island. I want to welcome you to this webinar that's being sponsored by Richmond County Savings Bank, which is now a division of Flagstar Bank. And it's also being put on in collaboration with the Doreen M. Inserra CPA PC and the Independent Association of Accountants. The webinar is going to cover taxes and changes that have taken place for 2022. You'll notice on this slide the word Watts is crossed out. Neither Doreen nor I have crossed this out. We don't know how this happened, but it's happened. So all it's telling us is that it has changed in 2022.
John, it just shows you the way Congress and the IRS function.
Okay.
True.
No.
Can you put it on? Come on, Joey.
Okay, you ready for me?
No, hold on a second. There's a little issue that came up here. Okay, just bear with me a minute. Okay. We have with us today also Leonard Andes, who is with the IAA, and he has a few words to say before we get started.
Okay, good morning, everyone. My name is Leonard Andes. For those of you who know the IAA, you know me. Those that have been on this in past years also know me. In a few minutes, I'll give you a little contact info and I'll post it later for myself. I just want to start off by thanking John and all his people, Richmond County Savings Bank, and Doreen, as I usually do, but this year I owe a little more thanks to Doreen. I've been kind of out of sight, out of mind, dealing with a little personal matter, and Doreen kind of picked up the slack and made sure the IAA kept running. So a very big thank you to everybody I just mentioned, a little exceptional one for Doreen, so that we kept everything going this year. For the IAA members, two things. Number one, we do have another seminar coming up on January 17th. I believe the starting time will be about 6 o'clock. It's our usual annual update with Warren Bergstein and Jack Gold. All right. And by that time, hopefully Congress will have made all their changes, extenders, and God knows what else they're going to do.
Okay, I just want to take a moment to introduce Doreen. Now, Doreen is not new to the scene here. Actually, Doreen has been working with SCORE. It's got to be 10 plus years. She's been doing this for us every December, and she has her own practice. She winds up providing services to individuals, businesses, estates, and she also winds up being a mentor, an expert mentor for us at SCORE. With that, a copy of her bio that you see on the screen now will be included with the slides that you're going to receive.
Thank you, John. Okay, so both you and Lenny will mute and stop your videos so they could see my speaker mode here. And I'm just leaving it on this slide right now because I want to bring you down to the bottom where it says 9 out of 10 keywords. Remember, we're going to do 50-minute sessions. This is eligible for 3 CE and CPE taxation credits, and you need to get 9 out of the 10. There'll be 3 in the first 50 minutes, 3 in the second, and so on, and they will be highlighted in red. I'll bring them up and I'll leave them on for about 30 seconds or a minute or so. So let's get right to it. All right, the Inflation Reduction Act of 2022. We're going to talk about the Infrastructure Act, and we're going to talk about the Written Information Security Plan. Also, I'm going to give you strategies for year end So we have a lot to cover. As you know, that was my bio. In the accounting field for 35 years and practice over 25 years here in Staten Island. Working with SCORE, probably 15 years on these presentations, like John said. Honorary member in 2013, also Lewis R. Miller Award in 14. Past president of the New York State Society of CPAs Staten Island chapter. I'm a certified government financial manager, as well as have my cybersecurity services certificate that was issued by the AICPA in 2018, and glad to be a member and current vice president of the Independent Association of Accountants on Staten Island, who always brings us these presentations. These presentations are very important. And, you know, we're going to be talking about a lot of information that is going to take effect in 2023, but we're also going to cover some 2022 issues. So you got to be listening carefully about what we're going to be talking about. Now, this slide may seem a little bit small, but it's going to get larger print as I go along. What does the Inflation Reduction Act mean for taxes? That was signed into law August 16, 2022. In there, there was a lot about healthcare issues, climate change, but we do have some tax issues. Now, some of them don't apply to our clients on a regular basis. For example, the new corporate alternative minimum tax. All right, we're going to look back any 3 years back. If your company, and this starts in 2023, your client's company doesn't exceed $1 billion in revenue, right? In average annual adjusted financial statement income. And as you will see in the tax world, we're merging a lot of the financial statement information with the tax information. This is where you look on page 4 of these corporate tax returns to see the book income. And so there's going to be an alternative minimum tax with regards to that. It doesn't affect many of us, but it's going to be in effect after December 31st, 2022. C Corps still remain at the flat 21% rate. Okay, now you see the word IRA on top. You think that's individual retirement account? No, it's the Inflation Reduction Act. That's the acronym that they are using for that. It was dabbled upon in that act that they were going to change the carried interest rules, mostly for the hedge funds, how long that you have ownership in there, the holding period. It was 3 years. They wanted to change it to 5 years. And the longer holding period would have applied to taxpayers with AGI over $400,000. That did not change. It's still 3 years. So I wanted to leave it in there because that was a little bit of confusion. In addition, for publicly traded companies, there's an excise tax on stock buybacks. And I have this a little bit larger on the next part of the presentation. Let's go down. And you'll see that's under section 4501, which is going to impose a 1% excise tax on stock buybacks. Many will ask, well, how is this going to affect me as either a regular taxpayer or a tax practitioner that does not deal with public companies? All right, it's effective after December 31st, 2022. But if you look at the bottom of the slide, after the law goes into effect, it is believed there could be some shift in behavior by these companies to distributing capital via dividends, okay, compared with the buybacks, because these buyback excise taxes, which generally are paid quarterly, are not going to be deductible. So if that's the fact, it will create more corporate distributions and it will cause current recognition to shareholders, all right? That will cause more income tax to shareholders. But at the lower capital gains rate, which would be 15%, depending if you're under that 12% tax bracket, up to 20% if you're in the 37% bracket. Okay, so it does affect us somehow, believe it or not. So these are all new excise taxes when we talk about that stock buyback, and that's on IRS Form 720, and it is done quarterly starting in 2023. A little bit more about that. Let's go to the next part of the presentation here under the Inflation Reduction Act. There has been a big expansion with regards to research tax credits applied against payroll for small businesses. Limits on business losses as well as clean energy tax credits. And we're going to go over that in the next couple of slides. So let's talk about the research and development expenses. This started under the Tax Cuts and Jobs Act expansion in 2017, effective in 2018. And as part of that act, a time trigger was included that requires what's called a qualified Section 174 R&D and expense. Under the current act, these are to be capitalized now effective 1/1/22. It used to be that you were able to write them off in the first year under Section 174. All right, so that's the change. In the US, these R&D expenses can be capitalized over 5 years, and that's straight line, foreign-based over 15. And in the first year, all expenses are assumed to be occurred mid-year, July 1st of 2022. So that tax deduction for US expenditures will only be about 10% in the first year. And sold or abandoned costs cannot be recovered in this particular legislation. Now, the above rule pretty much focuses on includes website and software development costs. All right. I do have C corporations that have this, that can elect these types of credits. So it is something that the practitioner on a regular basis could use. Under the old rule, however, we had a couple of options. So let's go down to that. Under the old rule, especially focusing on website and software development, you could have either done an immediate write-off as Section 174 expense, 3 years straight line recovery, or 5 year straight line recovery. Now it's a 5 year straight line recovery, and for the US Corps, and for foreign, 15. And you can include in the research and development costs, subcontractor costs for R&D are also allowed. In addition, there have been instances where some of these R&D credits have been denied by IRS. And in October of 2021, taxpayers must identify all the business components, each component that makes up this credit, who's working on it, how many hours, what are they doing? And this information had to be subsequently supplied to the IRS, and they're allowing a grace period that goes to January 10th, 2024. Generally, if the agency sends you a denial notice, you will have 45 days to respond to that. The business will have 45 days, and with the help of the practitioner to respond to that. So I just want to let you know that that is available. Okay, so now let's go to the next slide and zone in on what this credit is. Currently, the qualified startup business can elect up to $250,000 of qualified research credits to offset payroll taxes. The election is available to businesses with annual gross receipts of $5 million or less. Those are considered the smaller businesses. So the new law increases that 250 cap to 500,000 after 2021, which is the year we're in now, 2022. And the key of the startup is that you couldn't have had income generated prior to the last 5 years. This is different than what we experienced when we were getting the employee retention credits, right? Because we were looking at, and the PPPs, we were looking at February 15, 2020. Now we're going to be looking back from the last 5 years, all right? So they must be considered startups and not have generated income with regards to that last 5 years. So the Inflation Reduction Act is potentially doubling the R&D tax credits. And of course, as we said, this is good news for these small businesses. It would permit this additional credit for tax years starting after 2022. Now, for the excess business losses, this is applicable to sole proprietorships and individuals, trusts, and estates. And remember, this originally came out of the Tax Cuts and Jobs Act. Then it was suspended by the American Rescue Plan Act in 2021. So from 2018 to 2020, we had those limitations. 2021, it was suspended. And now in 2022, it is back. And so for 2022, the thresholds are 270,000 limit for unmarried taxpayers, those are your singles, and a $540,000 limit for married filing joint, which means if I have a net operating loss that's carried forward, or I have a net operating loss in that current year, and I add those together with regards to, now remember, the Tax Cuts and Jobs Act said those were for 2017 and going forward. And then we had changes when we went through the pandemic. But for this act, the IRA, the Inflation Reduction Act, extends the provisions through 2028. And it's the provision was set to 26. So there is an extension on the limitation of excess business losses. Okay, so let's look at how the Inflation Reduction Act and the Infrastructure Investments and Jobs Act work together. What are they providing here? Well, the Inflation Reduction Act was passed August of 22, and the Infrastructure Investment and Jobs Act was passed November of 2021. But there are investing implications between the two of them, which include healthcare, energy, technology, and of course more that we're going to talk about. The legislation includes $350 billion in new and expanded incentives, as we said, for energy efficiency, renewable and clean energy investments, fleet decarbonation, you've heard a lot about that, and of course, infrastructure improvements and sustainability under the ILGA, or what is known as the Infrastructure Act. Okay, so we have to, as Lenny was saying, keep an eye on Washington. Right now, they're looking at the omnibus bill. They're looking to balance their budget. We're just covering the tax acts that are in place at the time. So, but you always have to keep up to date on these issues. Now, the Infrastructure Investments and Jobs Act already allotted $200 billion towards sustainability. And you're going to see a lot of this in the accounting world and a lot of this in reporting with public companies, right? The Inflation Reduction Act allocates over $280 billion more in sustainability tax credit budget provisions, and this goes through 2031, and appropriated $65 billion in sustainability granting. And on this next slide, you will see the breakdown of these credits and grants. You're going to see a lot of this is going to apply to your smaller business taxpayer and small individual taxpayer. But this is a breakdown in billions of the areas that they're focusing on. For example, the clean energy production credits for $92 billion, non-commercial credits, and also commercial green credits for buildings, carbon capture, $16 billion, clean renewal, fuel credits, $9 billion, fleet and EV credits, we heard a lot about that, $5 billion, energy efficient building credits, $2 billion, and of course your low emission vehicle fuel grants of $6 billion. So there's a lot going on. And so let's see what they have in store for us. The American Rescue Plan also works in between here. We have seen that there was a debt relief provision that allows us to exclude it from gross income for federal income tax purposes. And that's between 2020 and 2022, while all these other acts are proceeding. We do know that the executive order under the student loan relief that Biden passed or tried to pass has now been put on a stay. About 9 million people had filed for that, and that is not proceeding as yet. Also, the student loan repayment pause that you see at the bottom of this slide, 19, was supposed to end on August 31st, 2022. It was then extended to December 31st, 2022, and now will resume down the road to June 30th of 2023. So we have an extension to 2023, and then July 1st, we proceed. Okay, so all of these are happening as we cover each of these two main acts. All right, so in the Inflation Reduction Act, we know there's an enforcement provision. That was one of the first things that came out, the funding to the IRS with regards to enforcement. And so the confusion was that all of that 80 billion was going to go to hiring either special agents or revenue audit agents. Well, this slide shows you the breakdown of where the appropriations are going to occur through taxpayer service, enforcement, their own operations, business modernization of the IRS system, as well as funds being allocated to an e-file task force. In accordance with the IRS mission, IRS is stating that they are not going to raise taxes on low to middle income taxpayers through audits for those with a taxable income below 400,000, although that is not written in the law. So let's see where the allocation of the 80 billion on slide 21 here is going to. Now, this appropriations is going through September 30th of 2031. The legislation allocates the 80 billion. 45.6 billion is going to enforcement. So that's about 57% is estimated will be going to enforcement and collection, legal and litigation, and investigatory services. Almost 26 billion for operations support, 5 billion for technology modernization, and 3.2 for taxpayer related services. As this was all going on, it had been reported that about 1,250 IRS workers delinquent on tax bills are going to, were identified, and they were working with them to get them into compliance. Similar to us as practitioners, when we have to renew annually our PTIN, and they ask us if we are compliance. So there was a lot of kickback on that. So let's look at the enforcement appropriations, which is to close the tax gap. And the tax gap is estimated to be something near $350 billion. What they're going to be obtaining in these appropriations are providing legal and litigation support at the IRS, conducting more criminal investigations, monitoring digital assets, and carrying out related compliance activities, as well as enforcing criminal statute violations and FinCEN crimes. We're going to see a lot of that with regards to crypto later. So the first key word, and as you see, it's in red. It's actually not a word, it's an acronym, but I thought it would be something that you would remember. The first key word is IRS. So please jot that down. We need that on your survey. Remember, there's going to be 2 more keywords in this segment, and you need at least 9 when we get to the end. So the first one is IRS, IRS operations support categories, and that's where some of this funding is going to. The IRS does have to pay rent. So this funding is going to help for rent payments, facility services, postage for correspondence to the practitioner and the taxpayers, security, research, and telecommunications. And also, if you look at the bottom here, the Inflation Reduction Act of 2022 also gives the IRS $15 million to design a service allowing taxpayers to electronically file returns with the agency without the need of third-party preparers. So that's an interesting concept right there. Taking the practitioner out of the picture with a $15 million window, and that's expected to start in 2023 with 2-bar coding. And we'll see how that plays out. Okay, IRS, remember that was the word. Jot that down. Okay, taxpayer services at the IRS is also going to receive over $3 billion. And that's to help with, again, this pre-filing assistance, outreach and education, account services, taxpayer advocacy, maintenance, their own maintenance, and information technology as they're trying to modernize the IRS systems and upgrade their legacy systems. Okay, so when this first came out about the allocations, and the commissioner, the past commissioner of the IRS, Charles Reddick, they went to him and said, are you going to do more audits? And he had stated that, look, part of the funds will go towards tax enforcement, but it will also go to services for taxpayers and technology. And also the Treasury Secretary, Janet Yellen, was stating the same, that but there's nothing written in the legislation that the audits will not occur. They're just saying they're not going to target those areas. There was an interim commissioner, you see at the bottom of this slide, named Douglas O'Donnell. He was a deputy commissioner and longtime IRS official. In the interim, he was leading the agency. That began in November, and that was reported in late October. Okay, so again, this funding to the IRS is going through 2031. And so there are many questions about the audit rate. So I thought this was interesting for you to learn about in the middle of this slide. 57% of the 80 billion is going to be allocated to IRS enforcement activities. And as I said, the Treasury Secretary, Yellen, has directed IRS not to use the additional funding in the IRA to provide or increase audit rates on small businesses or households making under 400,000. Again, this is not written in the legislation. However, for years, on the bottom of the slide, the IRS has been criticized for not auditing high-income individuals at the same rate as low-income individuals. So between 2011 and 2018, audit rates on individuals making over $1 million per year fell by 80%. And another study by the National Bureau of Economic Research found that the top 1% of Americans failed to report approximately 20% of their income, hence the tax gap that I was talking about previously, which is about $381 billion annually. And studies are saying, and that's been maintained at that number, they can't chip away at it, but studies are estimating that between 2020 to 2029, the net tax gap is going to be in the area of 750 billion annually. So we are going to see enforcement, we are going to see collection. It's just we have to make sure that we're doing our Circular 230 due diligence when we're working with our clients and when the taxpayers are getting their information together. In addition to all of that, the Inflation Reduction Act of 2022 also brought Medicare savings. It provided through the U.S. Department of Health and Human Resources and Services to negotiate prices of certain prescription drugs in the Medicare and Medicaid area. And the CBO, which is the Congressional Budget Office, estimates that $288 billion will be saved by allowing Medicare to negotiate. And in addition, the drug programs, also known as Medicare Part D, will include a $2,000 cap on out-of-pocket drug spending for seniors beginning in 2025. So that just, that is what you see in the healthcare area. There's a lot going on in this act. And like I said earlier, we had the limitation on your small business losses, your excess business losses of what's known as non-corporate taxpayers. That was originally suspended under the American Rescue Plan. So what's a non-corporate taxpayer? That's your pass-through, right? To your shareholders, to your partners, to the individuals who are filing their personal returns and filing net operating losses, okay? That's where this limitation comes in. So under Section 172, there is now an 80% taxable income limitation, which was brought in under the Tax Cuts and Jobs Act, and they brought that back. And under the American Rescue Plan, extended to 2026 through 2029. Now for 2022, the accounts under the Inflation Reduction Act are now limited, as we talked about earlier, to $270,000. So if you're dealing with a net operating loss, you're going to have a limitation, right? And that has to then be carried over. That's for a single, or $540,000 for married. And it's at the S Corp and partner levels. C Corps are not subject to this limitation. Okay, so as we said, Section 461L was set to expire at the end of 2025. ARPA, American Rescue Plan Act, which was passed March 11th, 2021, extends this provision for an extra year to the end of 2026. The new law, which is the Inflation Reduction Act, extends the application of Section 461L for 2 additional years, such that that section now applies for tax years beginning after December 31, 20 and before January 1, 29. So now we are, except for that area where we had 2021 and sort of like a carve out. So we have to be aware that we have limitations, and we're going to have to use those when we're strategizing for our small businesses at the end of the year. Okay, so let's go down to the next slide. This area I like. This is more of a positive area. There's not limitations. It's the premium tax credit. So we know that we all receive from a client their health information. We don't want all their medical and health information, right? Under HIPAA, we don't want to keep those. But what we need is our 1095s. If they go to the marketplace and they get their individual and or business insurance, we need the 1095 for the individual. So that we can put in the information with regards to their premium tax credit. And in fact, they will not allow you to file the tax return if you don't have that 1095 information on file. But what you'll notice on the 1095 is that you will have whatever premium tax credit was provided during the year and when they're covered and what that plan cost was. But what you don't have anymore is what that under the exchange purchase qualified health plan, what the applicable second lowest cost silver plan is. Now, why do we need that? That's under section 36B2. If you don't put in your applicable second lowest cost silver plan in the zeros of your 1095 on your software, that client calculation of premium tax credit will not be done correctly. And since the expansion, you can have a married couple who is generating almost $250,000 in adjusted gross income who could be eligible for the premium tax credit. So this is very important. It's a dollar for dollar credit, right? So we need to understand how this works and how it was expanded. So like I said, the applicable second lowest cost silver plan, depending on the state, is the applicable benchmark for this premium tax credit. Now, the premium tax credit was in legislation for the American Rescue Plan Act of 2021 was expanded and enhanced. So we actually saw in 2021 that we had not a give back of the premium tax credit or a payback, and we had an expansion. We saw people being eligible for the premium tax credit, and that was extended for 3 years to December 31st, 2025. And section 36B premium tax credit is reported on the form 8962. And if you do not complete that form and information is on file for that taxpayer for the 1095, that form will not e-file, So you need to get that information, make it part of your organizers. Okay, so what are we talking about here with regards to income limits these days? It's under section 36B(c)(1. Providing that the premium tax credit is generally available to individuals with household income, and that's total income. So you're going to include full Social Security between 100% and 400% of the federal poverty level. Now, under the American Rescue Plan Act of 21, individuals with household income above 400% of the FPL were eligible for this premium tax credit. We saw that in 2021. In 2022, the new law amends section 12001A and 36B3A3 now provides that under the Inflation Reduction Act, it extends the ARPA rule for 3 additional years through December 31st, 2025, okay? And also there is a superseding of tables under Revenue Proc 2022-34. Which you'll be able to get at irs.gov. But you need to be aware, again, for your planning at year end, that these premium tax credits have been expanded when you're doing your fourth quarter estimates. Also be aware that if you remember when we first started out with the Affordable Care Act, the calculation for affordable health insurance was that the taxpayer might have to spend as much as 9.12% of their household income on health insurance premiums. Now it has been capped under the Inflation Reduction Act of 2022 down to 8.5% from 2023 to 2025. So you had legislation, you're going to see a lot of this contradiction on the slides, where it talked about going into 2023, but then the Inflation Reduction Act, in this case, overrode it. So we have less contribution by the taxpayer for their health insurance premiums. Okay, so the taxpayer at 150% of the federal poverty level in 2021 under the American Rescue Plan Act would not have been eligible. However, under the ARPA and now under the Inflation Reduction Act, the taxpayer is eligible, okay, for about a $1,250 credit. So tax professionals on this presentation need to be aware of this change, which allows more people to claim that Section 36B. So you need those 1095s, and you need each state's second lowest silver plan to put that in. And these amendments in the Inflation Reduction Act apply for tax years beginning after December 31st, 2022. So you'll see a lot of this going into 2023. When we talk about the energy credits, we'll talk about 2022 and 2023. Okay, and here we go. We're at our next word. So our first one was IRS. Our second is energy, right? We know the Inflation Reduction Act and the Infrastructure Act of 2021 talk a lot about energy. And I know your clients are going to be very interested. I've already been getting calls. I bought this, I did that. And so there's a little bit of a transition because we're in 2022 and the Inflation Reduction Act talks a little bit about 22, but then also goes into 2023. So energy is the word, jot that down. That's your second word. And this slide talks about non-business energy property credit because there's a lot of business and non-business credits. So what do we have? 25 CG2, that's the section, provided that the 25C section, non-business energy property credit, had expired on December 31st, 2021. So we figured, okay, we don't have to deal with it again, but it has been extended. So a lot of these in this first part were subject to a 10% of the amount paid where you could get a credit. And of course, there was a maximum lifetime of $500. We're going to see that's still available in 2022. So they're still going to have to put in that form 5695 that they had a $500 or use their $500 limitation. When we get into 2023, we're going to see that goes away and there are new annual limitations, okay? So that's something you're going to get asked about quite a bit, and let's just clear that up right now. The Qualified Energy Efficiency Improvements, which is your Section 25C, large C, small c, provides that quality and qualified energy efficiency improvements are any energy efficient building envelope components. So what's a building envelope component? All right. It's essentially in these areas, exterior windows, exterior doors, skylights, and metal roofs or asphalt roofs. All right. Those are your building envelope components. And these focus on permanently being designed to reduce heat gain or heat loss. All right. So, and they must have the certifications and specifications in place. Now, the reminder for the tax professional is under Section 25CB2, there's a limit to these, $200 specifically for the windows. Okay. And remember, we're still dealing with the $500 lifetime credit in 2022. So going on, Section 25C, capital C, small b3 credits, it provides a fixed dollar amount ranging from $50 to $300 for energy efficient building property. And that will phase out in 2032. Okay, so as we know in 2022, the 10% max credit of these eligible costs where the maximum lifetime is $500. And they include your furnaces, your boilers, your electric heat pumps, and water heaters. In addition, you have central air, which that has to achieve the highest efficiency tier, and that's measured by the Consortium for Energy Efficiency, and that was in effect as of January 1st, 2009. So we're actually extending a lot of this out. This legislation covers a lot of the presentations we have done in the past for SCORE. There are advanced main circulating fans that you could put in your home, limited to $50. This amount was subject to also the lifetime cap, and the practitioner and the taxpayer would be reporting this on IRS form 5695 on page 2. You're going to see a lot of 5695 work, right? In addition to the premium tax credit that we just talked about. Because why? These are all dollar for dollar credits. Okay. Let's go on to the next page. So we have to be aware as practitioners. All of these energy improvements must meet Energy Star program requirements. That means the documentation in your records must prove from the manufacturer and should have it from the retail shop that you purchased it from, Energy Star program requirements and other criteria that was established originally in 2009. So we're going back to that under the International Energy Conservation Code. Okay. And that also came in effect under the American Recovery and Reinvestment Act of 2009. Just trying to refresh your memories that this has been around for quite a while, but then stopped when the Tax Cuts and Jobs Act of 2017 came into place. It wasn't that it was stopped, but there was like a phasing out, and now we're back. Here we are. Okay. And when that was first put into place, we were talking about the taxpayer's principal residence. So the taxpayer's principal residence had to be in the United States. And of course, they had to be subject to Section 121 exclusion. What does that mean? When we look at an 121 exclusion, that's your primary capital gain exclusion on your primary residence. So when you sell your property, any 5 years back, you look at any two, rather, you look 5 years back from the date of sale, any 2 years within that period, you need to own or have lived in the property, okay, to get the exclusion. That's the principal residence we're talking about, all right? We can't have a second home in this area. It's your principal residence. So Section 25 CF provides that the taxpayer must reduce the adjusted basis of the principal residence by the amount of any credit allowed. So when you're doing these credits, you have to also simultaneously track the adjusted basis down from the principal residence. So when you go to sell that residence, of course, the cap gain will be higher. And if it's in the exclusion, that's fine. If it's not, then there's going to be capital gains tax that's going to be due. The Inflation Reduction Act extended Section 25C existing provisions retroactively for 2022. However, the 25C provision is amended beginning in tax years after December 31st, 2022. So what we just talked about now is what's current in 2022, and then going forward is 2023, okay? That we're going to see more expansion in this area. So the increased credit section, which is your Section 25CA, is providing an increased credit for a tax year to an amount equal to 30% of qualified energy efficiency improvements. And that amount has to be for the residential energy property expenditures paid or incurred by the taxpayer during the year. Now, we know that 30% generally was looking at our solar area. Okay, so the solar is still in there, but it has gone down, and we're going to see a phase out. I'll have a table for you, to the 26% level, all right, as this proceeds. Now, this is federal. We're not talking about state. This is federal. Under Section 25CA, which you see at the bottom, you have a home energy audit. That only gives us $150 credit. I don't quite understand this provision because it only gives you $150 credit, and you need to have a home energy certified auditor to do it. So that sounds like it's going to cost more than that, but it is available. Okay. Now let's proceed and look at what the qualified energy efficiency improvements have been amended in section 25, large C, small c. It revises the energy efficiency certification requirements for those building components that we talked about, right? The windows, the doors, etc., and eliminates treatment of roofs as building envelope components. And we saw this also in depreciation, where there was a change in the roof component. Okay, so this is now in the qualified energy efficiency improvement. There's a change in the building envelope component, moving the treatment of roofs. And it adds air sealing insulation to the definition of that building envelope component. And that was amended under section 13301D of the Act. A lot of stuff here. Okay, so now let's look at the residential energy property expenditure section 25, large C, small d, which provides the definition of residential energy property expenditures. It was substantially revised and includes a repeal of the requirement, right, regarding that the taxpayer's residence had to be the principal residence. So the term now residential energy property, again, we're going into 2023, means expenditures made by the taxpayer for qualified property is for a dwelling unit located in the US. So we're not only talking about the primary residence that we talked about under the old law. The term residential energy property includes expenditures of labor costs as well. You can put that as part of the whole package. And of course, it can include on-site preparation, assembly, and the original installation of the property. So now we can look at a dwelling unit in the US and not only the principal residence. Again, looking at 2023. Okay. The annual limitation in lieu of your lifetime limitation. Now remember, you had the $500 lifetime limitation on that non-business residential energy credit. That's still around for 2022. For 2023 going forward, you're going to have these new limitations. The Act is going to, or the Act does repeal the lifetime credit limitation. And that was amended under section 25, large CB, which now limits the allowable credit to $1,200 per taxpayer per year. You know you're going to get asked these questions. In addition, there are annual limits of $600 for credits with respect to residential energy property expenditures. And these again are your windows and skylights. All right. And $250 for any exterior door, with a $500 total limitation for all exterior doors. This is the new legislation looking at 2023. So let's look at an example. When we do an example, it always helps us to understand the legislation. So in this example, we have in 2023, Don spends $2,500 on Energy Star windows. And again, the receipt, the documentation must prove that. $700 on one Energy Star exterior door, and $900 on a second Energy Star exterior door. Don's credit is calculated as follows. He looks at the windows, the cost at $2,500, right? He spent $2,500 times 30% gives us $750. The credit is the lesser of $750 or $600. Again, that's in 2023. Therefore, Don's credit for all windows is limited to $600. Okay, but again, it's a dollar for dollar credit, right? It's going to come right off the taxes. Okay, now let's look at the second section of this example. We have exterior door number 1 and exterior door number 2. Same person, Don, spends $700, and we take 30% of that, which is $210. The credit is the lesser of the limit, which is $250 or $210. So therefore, Don's credit for door number 1 is limited to $210. Then $900 times 30%, right? That was that second door, is equal to $270. The credit is the lesser of, again, we look at the limitation 250 or 270. Therefore, Don's credit for door number 2 is limited to 250. The maximum credit for all doors then is 500, right? It's per door. Don's credit for all doors is limited, therefore, to the lesser of 500 for door 1 and door 2, which would be the for 210 for door 1 and door number 2 for 250, but it's the lower of, so it's $460 is what he gets, the lower of. So in this case, Don's total residential energy property expenditure credit in 2023 is $1,060, which is $600 for all windows and $460 for all exterior doors. All right, again, 2023. Example number 2, Don adds an air sealing insulation to his home in 2023 at a cost for $5,000. His maximum credit is the lesser of that 30% times 5,000, which is 1,500, or the 1,200 annual limitation. Therefore, Don's maximum credit for 2023 is $1,200 in this case. So there's a lot of calculations that is going on, right? That we have here. All right. Now, in addition to those limitations and calculations, we also have a separate $2,000 annual limit. What is that for? That's for your specified heat pumps, heat pump water heaters, and biomass stoves and boilers. These items are amended under section 1331C. Now there is, let's look at this example. There's a heat pump and biomass exception. That's the $1,200 annual limit and the $600 residential energy property limit. They do not apply to heat pumps and biomass stoves and boilers. So you have to know the exceptions as well. For heat pumps and biomass stoves and boilers, there's a separate annual credit of $2,000. So a taxpayer could spend up to $6,667 on a new heat pump or biomass stove or boiler and be eligible for the $2,000 credit. So we give an example. In 2023, Don spends $5,000 to upgrade their home's insulation and $6,600 to install a new heat pump. His credit is calculated as follows. The insulation is the lesser of 30% of the $5,000 he spent, equaling $1,500, or the $1,200 cap. So he gets the $1,200 in this case, the lower of. For the heat pump, however, he gets the lesser of 30% times $6,600, which is your $1,980, or the $2,000 limit. Of course, it's going to get the $1,980. When we add those two together, the $1,200 and the $1,980, the total credit for 2023 is $3,180. A lot of tax savings there. So we need to be asking these questions on the organizer. And if they're not on the organizer, we need to be adding it to our Q&A when we sit with the taxpayers and the clients. Okay. I told you about the home energy audit. I'm not really impressed with this area. It's only $150 credit, but there's a lot of criteria for it. We're talking about under section 25CA3, a home energy audit. And under the home energy audit, you need an inspection, you need a written report. I mean, it's good to get because then you could determine what's needed in your home. And this has to be for a dwelling unit. It doesn't have to be for a principal residence in the US, right? It could also be for the principal residence as well. And it's going to identify significant cost-effective energy efficiency improvements and help you with determining the credits. It will have a certification. And it is prescribed under section 13301F3A. Again, for that, whatever you pay for that, which I think would be a little bit costly, is going to be $150 credit for the home energy inspection report. All right, so that gets added to that area as well. The limits are on these sections that we provide here. That's section 25CB6A. Again, cannot exceed the 150. And there must be a substantiation requirement. which means that as the practitioner, and of course the taxpayer, is required to provide information and or documentation that may be required under that legislation. And lack of that documentation under section 6213G2, which has been amended under the 25C section, an omission will of course disallow the credit. Now, what about identification numbers? We know for the vehicles, we have to have the VINs. Well, for these products, you're going to have an identification number, and there's going to be a requirement. The requirement is that it's specified in service after December 31st, 2024. So you won't have to have that identification number until then, and it's going to be asked for on the return. Of course, if you don't put it on there, you're not going to get the credit. And previous to this, if the substantiation is not provided for the credits, they are permitted to disallow the credits on the return. And it looks like to me more of a mathematical error in the legislation, as opposed to where you can go and do an appeal, go to tax court and do an appeal, meaning you didn't provide the substantiation. So under the new law, we know this new law is revising old laws, right? We're seeing a lot of that. These laws, some of these laws were in place all the way back in 2009 that I talked about. Well, under the new law, section 13302A1 amends the law section 25DH. What does that have to do with? That has to do with an available credit for property installed in years before 2035, right? And for qualified battery storage technology. Well, I find that interesting. That's something that you could actually put into your home for your EV, right? And I've seen a couple of homes passing by and I see their EVs plugged in, and they did that in 2022. It appears to me that that legislation is not available for the qualified battery storage expenditure until 2023. So that's going to be a problem for those taxpayers because they weren't aware and it wasn't communicated correctly. Of course, it must be installed in connection with a dwelling unit located in the United States and used by that resident taxpayer. And of course, there's capacity provisions where the capacity cannot be less than 3 kilowatt hours. And this is your applicable sliding scale. This is for your 30% solar credit. Now you'll notice it's gone to 26% for property placed in service before January 1st, 2022, then 30% for property placed in service after December 31st, 2021, and before January 1st, 2033. So it's like going back and forth because of the changes in the legislation. 26% for property placed in service after December 31st, 2032, and before January 1st, 2034, and 22% for property placed in service after December 31st, 2033, and before January 1st, 2035. And there shows you the section of amendment, which is 13302A2. So what are the effective dates of all of this that we are talking about? Many, I said, was 2023. Some of the provisions, however, are for 2022, right? That we talked about. We said there's still a limitation. There's still some non-business energy credits in place that were the old credits that they expanded. However, the allowance of the credit for qualified battery storage technology expenditures is for after December 31st, 2022, as I talked about earlier, with regards to people putting those items in their home for their EVs this year. In anticipation of the legislation. So let's look at an example to clarify. Example number one, Don installs a $20,000 solar panel system on his dwelling. Now, let me just talk about this solar panel installation. Just so you're aware that you need to own the solar panel system, not lease it out. That taxpayer needs to own it. So it could be a financing where they will get and be eligible for this tax credit. So that's the number one clarification. Secondly, the solar company is permitted to put a lien on the home for the solar equipment. Now, according to legislation and according to contracts that I've looked over, it says this lien is assignable. Okay, but you should be aware of that a lien can occur when this equipment is put on the dwelling. And it could be found at the county clerk for that particular property. So in this example, Don installs a 20,000 solar panel system on his dwelling unit that he uses as a home in 2022. His credit is 30% of the cost of the 20,000 expenditure for the system. And as a result, his credit is $6,000. In example number 2, looking at that phase out of the table that we talked about earlier, if Don waits to install the 20,000 solar panel system on his dwelling unit that he uses as a home in 2033, his credit will only be 26%. Now we're going way out, but it's just going to show you that they now reduce the credit, okay, as it got later. And they lost, in this case, $800 of a credit. So I guess the assumption would be try to do this earlier in the legislation. Reminder, Section 25D residential clean energy credit is not a refundable credit, but it can be carried forward to reduce the taxpayer's liability. And I noticed this a lot on the state side. You have taxpayers implementing these solar panels to get the credit on the federal side, but sometimes they don't have tax on the state side and it gets carried over. It can't be offset. It's not refundable. In addition, the solar company is required to put in the paperwork to reduce the property taxes. So when they come to us as the practitioner, that's something that we cannot do. The solar company has to work with the tax departments of the state to do that. Now, what is interesting about this, and I don't want to stop at this point because I want to continue with the credits, there is what's called green credits for commercial properties, and also credits if you're an owner of a co-op, okay? If you're owner of a co-op. So in this example, Don is an owner in a housing co-op, owns 55 shares, which is 2.8947% in this example of the total outstanding stock in the corporation's 1,900 shares. If the co-op association itself spends $60,000 in 2025 to replace those windows with Energy Star, most efficient windows, then Don can report on his 2025 personal tax returns that he spent $1,737, which is what he spent on the windows, and claim also an allocation of what the co-op spent of $521. And I think this is lost a lot because taxpayers are not aware. They don't have all the documentation. Sometimes they don't know all the shares. They don't know all the allocation, but they could get a Section 25C credit added to their own credit in this case. So you're talking $1,737 plus the $521. And this is substantiated and permitted under the Office of Chief Counsel's letter in IRS Information Letter 210-0244, which there is a ruling that when a tenant stockholder arranges for and purchases the improvement themselves, they are entitled to a credit based on the entire expenditure. So, you know, this could be lost, and you got to ask these questions as well. If you're the taxpayer or if you are the practitioner. So let's just go down because somehow it went past. Okay, and there's also penalties. There's also penalties, of course. So an omission of that identification number that I talked about is subject to a summary assessment. What does that mean? That means it disallows the taxpayer the right to a petition in tax court. So we have to make sure as practitioners, we're putting down the right information, because if we don't put those identification numbers down, they could get a summary assessment, can't be fought in tax court. They're going to come back to you as the practitioner. All right. Again, effective dates after December 31st, 2022. Of course, the identification number for the products that we were talking about is 2024. But we're going to talk about the VINs, and that area is where they could do a summary assessment. And again, there's an extension on that $500 limit for 2022.
Doreen?
Okay, so with that, we're going to stop.
Doreen?
Yes, we're going to stop at this point, Lenny, and take a 5-minute break. We'll
Want to do
answer
a
any
couple of quick
Q&A.
questions first?
We'll do a couple of quick questions, and John or Bart could let us know when that 5 minutes will start.
Okay, let me give you the quick questions. Two came from Charlie Weintraub. One was, will real estate losses affect the health insurance credits even if they are suspended?
Will real estate losses
Affect the health insurance credits even if they are extended?
suspended, you mean?
Suspended, I'm sorry.
Okay. Now, is he talking about the health insurance credits? Because we didn't really cover health insurance credits with regards to the businesses.
I think
Right.
when you were talking about the premium tax credit. I
Oh, the
think-
premium tax credit. Okay, so that's based on, well, it's based on household income when you apply, okay, when you're applying at the marketplace. But when you're calculating the credit, right? If that loss is suspended in the household income in the calculation of AGI, because generally there's an AGI calculation on the form that you calculate the premium tax credit. So no, I don't believe that will affect the calculation if the real estate loss is carried over and suspended.
Okay. Hopefully that's good, Charlie. If it isn't, let us know. Charlie also want to know, are the energy credits limited to 500 per individual or per return?
It's per return. So if you're doing your married filing joint, it's going to be 500. If you're doing single, it's 500.
Okay.
It's
Laura
Form
asked,
5695. However, it's interesting because on the 5695, there's also something where you could split information on that form if you're sharing it with a non-spouse, and then that gets divided up between the two. So he always brings up an interesting concept there, Charlie.
yes. Laura asked, is the solar panel credit available for a vacation home?
Currently, the solar panel credit is available for a vacation home. I've had that instance where we put in a second home there, yes.
And I'm gonna let you take this because I don't remember.
But
the
again, you
answer.
have to own that equipment.
Okay, we're going to start this 5-minute break.
Okay.
Okay,
Okay, and I got one more question here, actually two. Where do you get a copy of the second lowest silver plan for the state?
You could just actually go on to the healthcare.gov site and they will have those, and they'll link you to the states, or go to the state site and put in their healthcare.gov in that state.
Okay, and I got one that's not written here, it's actually mine. So if you're in a condominium, Doreen,
Yes.
okay, and the condominium puts in a roof or a skylight, so you're paying for it as an individual through your association fees, but when you put it in, it applies to a specific home. Does anybody get a credit for that under the under the energy credits?
Well, the example that we just gave, in other words, which is after 2022, is that you can take a portion of, you could put in what the percent that you purchase, right, for those windows and skylights, and the condo or the co-op association based on the allocation, right,
Okay.
on that. But the co-op is more allocation of shares, right? They
So,
do have
in
the
other words,
condominium provision in there
In
too.
other words, in a condo, if the condo paid, let's just say 10,000 for my roof, okay, I would be allowed a deduction, a credit for my portion, my interest of that $10,000.
That's what they're saying.
Okay, but nobody else gets it, or does everybody get it?
Well, the owners of in that development.
Okay, so even if it wasn't my roof, every owner would get a piece of that.
Correct.
Okay, thank you.
All right.
Let's
So
do the break.
let's take the break. Let's leave it to maybe like a 2 or 3 minute break. All righty. Let's look at the new clean vehicle credit. It says it ended and now it's resurrected. So let's just go. It's a little convoluted, but we'll try to do the best we can here. So we have the section 30D, which provides that the amount of the credit is the sum of 2,500 plus, all right, and then there's specifics, for a vehicle that draws propulsion energy from a battery with not less than 5 kilowatt hours of capacity. And then there would be $417 for each kilowatt hour of capacity in excess of 5 kilowatt hours, but not in excess of $5,000. Okay, that's the first provision. But when you add these all together, there is a maximum. So we had a 5,000 on letter B here, and then we have the 2,500. So that's that first point. We take it together, we're at 7,500. The maximum credit is 7,500 regardless of the weight. So the Act changes how the clean vehicle credit is calculated, and it's broken up into two components under Section 30DB. It provides a $3,750 credit that the taxpayer is eligible for meeting what is defined as critical minerals requirement. Critical minerals requirement, okay? And a separate $3,750 credit for meeting the battery component requirement. And that's been amended under Section 13401A. Now, hopefully, when we're going into the dealer and we're purchasing these vehicles, this is going to be broken down on their documentation, right? So that we could determine if we should get, or if the client should get the $7,500 credit. So this was part of almost $370 billion legislation in energy security and climate change, because they determined, or through studies, that they project that they're going to reduce some carbon emissions roughly 40% by 2030. So that was the whole point of this clean energy tax credits in the home energy area that we talked about, which was about $9 billion, and a tax credit up to $7,500 for the purchase of zero emission vehicles. Okay, and it's based on certain vehicle cost amounts that have to be specified under thresholds, and for sedans versus specified amounts for vans and pickup trucks and sport utility vehicles. So we're going to need to be wary of that, and we're going to go over that. Now, what this slide is talking about is that to be eligible for this credit, there is what is called a final assembly requirement. Meaning, when you have all these parts of this vehicle, depending on what it is, they have to be assembled. The final assembly has to occur in North America. All right, and those are the sections that I provide you. Section 13401B, Section 30, large d, small d, 1G, provides that the final assembly means the process by which the manufacturer produces a new clean vehicle through the plant, a factory, or another place, right? That is going to be delivered to a dealer or an importer. The components must be put together in North America, and that's your final assembly requirement. And that applies to vehicles sold after the date of the enactment, which the Inflation Reduction Act was passed on August 16, 22. So it's after the date, right? August 17th is when it starts of 22. Now, there are FAQs at irs.gov, which you could find more about on the requirements and the changes that qualify the new EV credits under this act. We're going to try to cover as much as we can here. So with this act, there's a two-step process to check whether the vehicle's final assembly occurred in North America. So first, we're going to look at the Department of Energy's Alternative Fuels Data Center, AFDC, and see if the model is listed. Okay, there's a model year 22, and then there's the early 2023 electric vehicles that meet the North American final assembly requirement. And we're going to talk about later, what if you owned a vehicle and then it was transferred to someone else? Okay, and you had already taken the credit. But you're going to use the Department of Energy's Alternative Fuel Data Center to see if the model is listed there. Second, they can enter the VIN, right, the vehicle identification number, into the National Highway Traffic Safety Administrator's VIN decoder tool. And that tool refers to where the plant, where that vehicle was put together, field, which lists the build plant and country of the vehicle. All right. This is to determine that final assembly requirement. Okay. So that brings us to our first word, right? Which is electric in this area, electric. All right. So we're talking about EVs, which are your electric vehicle credits. And as we said, there's this two broken down into first the 2,500 and 5,000, which is your 7,500. And then it's really broken down into two components, 3,750, 3,750, based on how it was put together, equaling the 7,500. And then final assembly must be in North America. Okay. So it's a credit for up to 7,500 for the cost of buying a new qualified EV. And that is extended through 2032. And the Inflation Reduction Act of 2022 created the credit, okay, created the credit. And the credit can be claimed for single filers with modified adjusted gross income. Now, modified adjusted gross income, we're going to talk about in a bit, is going to be talking about adding back certain items to adjusted gross income. Above 75,000 for singles and 150,000 for joint filers. Okay, so there is a threshold. There is a threshold, because I was actually able to do the credit in the previous year. And I did that on a return for a client who was making about 600,000. So as you can see, there's certain thresholds in place now. So here's your applicable percentage tables in this area. And you'll notice it goes from 2023, starting at 50%, right? And increases over time by 10%. So when you get to 2029, you're at 100%, right? And this was amended under section 13401E1, and it's now known as section 30 Cap D E1 Cap B. And it provides that for vehicles placed in service in different years, there's applicable percentage rates that must follow. All right. And as you can see, the first one is 2023. So we're talking about legislation effective in 2023. All right. So what are the limits on the manufacturer's suggested retail price and the income thresholds? All right. So section 30D, Cap D, small d11 provides that the clean vehicle credit is not allowed for a vehicle with a manufacturer's suggested retail price in excess of an applicable limit. And for vans, sports utility vehicles, and pickups, that limit is 80,000. For any other vehicles, the limit is 55,000. What about the modified adjusted gross income? Now, adjusted gross income is generally all your income from the top of the return, but allowing above the line adjustments, which usually we'll see Schedule 1 on the return if you're familiar with it. But in addition, for this purpose, the section 13401F states that a modified adjusted gross income is defined as adjusted gross income increased by the following. Section 911, foreign earned income and housing exclusions. Section 931, income from Guam, American Samoa, or the Northern Mariana Islands. And section 933, income from Puerto Rico. Okay, that all gets added back to determine the threshold here, which in the MAGI is your 300,000 for taxpayers filing joint or surviving spouses, 225,000 for head of household, and 150,000 for other taxpayers. Now, the dealer that you're working with must be registered with the IRS and meet other requirements that the IRS puts upon them so that they can, the dealer themselves, get certain advance payments with regards to the EVs. Again, we're talking about 2023. All right, so now the rule, there's another rule where you can transfer the clean vehicle credit, all right, to vehicles placed in service after December 31st, 2023. There's a transfer of the credit, and that goes to December 31st, 2032. All right, where a portion of any clean vehicle credit allowed to a dealer that is direct spending will be increased by 6.0445%. So this is really more for the dealers, right? Where there'll be a transfer of these credits. VINs will be required again to be recorded on tax returns. Do not leave the VINs out because that would be a summary assessment, which means you can't appeal. All right, so let's look at the transition rule in this case for an EV. A taxpayer who after December 31st, 2021, and before the date of enactment of this act, which is the Inflation Reduction Act, dated August 16, 2022. So if they bought this EV between this time, they purchased it, they entered into a written binding contract to purchase it, and it's known as a new qualified plug-in electric drive motor vehicle, or NQPE DMV. You're going to see that on a lot of forms, and placed it in service after the date of enactment, right? August 17, 2022, may elect to treat that EV as being placed in service before the date of enactment. Now, what happens if they do that? Well, there was no AGI test, as I told you, before the date of enactment. I was able to do it for a person who had adjusted gross income, modified adjusted gross income of over 600,000. So before the date of enactment, you say, oh, great, there's no AGI limitation. However, there was a limitation on the number of vehicles that were manufactured for that provision. So if it hit that max for that vehicle, that EV, then you're not going to be able to take it. All right. Then you go under the new legislation. So the effective date of the transition rule, it applies to vehicles placed in service after December 31st, 2022. That's for the effective date of the whole legislation. The transition rule is the period that we just talked about, okay? For EVs. Remember, we're focusing on EVs in this area, what are known as clean vehicles. So under the Inflation Reduction Act, passed in August 2022, new Section 25E provides that a qualified buyer who acquires and places in service a previously owned clean vehicle after December 31, 2022 is allowed an income tax credit, which is the lesser of, and we didn't know about this calculation, of $4,000 or 30% of the vehicle sales price. All right, so this first step here. And then, of course, no credit is allowed if the lesser of the taxpayers, as we talked about, modified adjusted gross income, based on your filing status, in the year of purchase, exceeds $150,000 for a joint tax return and surviving spouse, $112,500 for head of household, or $75,000 for others. And something interesting here, for the year of purchase or the preceding year. There's a little caveat here. All right, they must be in that area. What is a previously owned clean vehicle? That's under Section 25, large EC1, which provides that a previously owned cleaned vehicle is a motor vehicle. Okay, the model year of which is at least 2 years earlier in the calendar year in which the taxpayer acquires it. For this specific provision, 2 years earlier from the year, the calendar year in which the taxpayer acquires it. So that original use of that vehicle starts with the person, and it has to be other than the taxpayer. And that's considered a qualified sale. Can't be the taxpayer, and which generally meets the requirements. So they're buying it from someone else, not themselves, which generally meets the requirements applicable to vehicles eligible for the clean vehicle credit for new vehicles, or what is known as the clean fuel cell vehicle. And of course, you're going to see this 14,000 a lot throughout the legislation. They must have a gross weight rating of less than 14,000 pounds. And that's under a new provision that was added, section 13402A. Okay. More definitions for previously owned vehicles. Now that qualified sale that I talked about, which means the taxpayer cannot purchase their own assets. It has to be from someone else, an EV, a clean vehicle from someone else, is a sale of a motor vehicle by a dealer for a price of $25,000 or less. So it's kind of a low price there. And then we look at that first transfer. That's what we're talking about with definitions of previously owned vehicles. And the qualified buyer is defined under section 25, large EC3, which provides that a qualified buyer is an individual who purchases the vehicle for use and not for resale, meaning they're not a dealer. Okay. And also, they cannot be a dependent of another taxpayer. So, we saw this with the economic impact payments, where are they dependents? Are they not? Can they get their own EIP or not? In this case, the dependent is either allowed or allowable test. In other words, even if that taxpayer didn't take their dependent, but they could have, that dependent cannot get this credit. Okay. So he's not a tax dependent of another taxpayer and has not been allowed a credit for a previously owned clean vehicle during the 3-year period ending on the sale date, that qualified sale date. So what do we have to be aware of as practitioners in this area? The provision allows a taxpayer to be eligible for the credit every 3 years in this area. So if the taxpayer purchased a vehicle on January 1st, 2023, that would be the effective date. Then they are eligible again on January 1st, 2026, and then January 1st of 2029, and then January 1st of 2032. And then it's scheduled to expire December 31st of 2032. Okay. What about the transfer of the credit of a previously owned clean vehicle? Those are for vehicles acquired after 2023. And you can be able to elect up to the time of that qualified sale that I talk about to transfer the credit to the selling dealer, back to the selling dealer in exchange for cash, a partial payment, or a down payment in an amount equal to the credit. And it doesn't prevent you from getting any other incentives from that dealer or from the manufacturer. So it does have a dollar value to it with regards to the customer and the dealer of the cars, the car dealer. Now, the effective date and termination of the credit is for the previously owned clean vehicle credit applies to vehicles acquired after December 31st, 2022, but will not be allowed for any vehicle acquired after December 31st, 2032. And the credit transfer provision applies to vehicles acquired after December 31st, 2023. So now we're talking 2024 there for that transfer. All right. Now, January 1st, 2022 to August 15, 2022, which is right before when the legislation was put into place, when they purchased that clean vehicle, they're under the old rules. But I said you had an option where you can look at to see if you would be eligible for that exception that we talked about earlier, right? You had the exception of using that old rule with no AGI limitation, but if there was not enough, there was a limitation on the vehicles and you weren't able to use that old rule, you could then look to the new rule. Okay, what about our commercial clean vehicles? Commercial clean vehicles. The Inflation Reduction Act adds a new provision, Section 45W, which is known as Qualified Commercial Clean Vehicle Credit for qualified vehicles. And that's for vehicles placed in service after December 31st, 22. And the credit is done on the General Business Credit Form, Section 38. So you're going to have that 3800 form where you're going to put your credits down. This is where you list it. And it provides that the credit per vehicle is the lesser of 15% of the vehicle's basis, 30% for vehicles not powered by a gasoline or diesel engine, or the incremental cost of the vehicle over the cost of a comparable vehicle powered solely by a gasoline or diesel engine. And again, as we said earlier, the maximum credit is $7,500 per vehicle with gross vehicle weight ratings of less than 14,000 pounds, or for heavier vehicles, 40,000, okay? Now, a lot of us have businesses, so we're concerned with the qualified commercial clean vehicle and how it's defined. It's defined under that section 45 WC. It provides that the vehicle must be acquired for use or lease by the taxpayer and not for sale, and it must be under that 14,000 weight, and of course, regarding the kilowatt hours. Qualified commercial fuel cell vehicles are also eligible for the credit, and qualified vehicles are considered depreciable property. And we're going to see that later on, we have green depreciable property that has been added. And of course, a VIN is required. It's for those vehicles that are acquired after December 31st, 2022. Section 45 WG provides that no credit will be available for vehicles acquired after December 31st, 2032. So it's after 2022, but not after December 31st, 2032. And the vehicle must meet requirements of section 30, large D, D1, cap D, D1, small d1, which requires that the final assembly of the vehicle occurs in North America. We talked about that, right? And you'll have to report it on your general business credit. So let's look at the credit extended to eligible property placed in service January 1st, 2033, and the eligible property placed in service after, right? It says it goes to before January 1st, 2033. It can't go after that date, and after December 31st, 2022. All right, and that eligible property, which is different now from the vehicles, just to revisit, is the bi-directional charging equipment that we talked about earlier when you see it on your property with regards to a charging station. All right. So going down to the bottom of the slide, for 2022, the existing rules apply, but for 23 to 32, that's where the changes apply, just to summarize what we talked about. Now, when the Inflation Reduction Act was passed in August of 22, a few days later, the Financial Accounting Standards Board, FASB, passed on August 22nd, 2022, a proposed accounting standard. The goal of the standard was to improve accounting and disclosures for investments in tax credits. So, and structure. So you need to be aware of this on the accounting side, because we talked about in previous presentations how the financial statement presentation is now marrying with the tax presentations in some cases, right? In more and more cases. The amendment in the proposed accounting standards update would enable reporting entities to account for their tax equity investments using proportional amortization method under specific conditions, regardless of the program for which they received the income credit. So certain provisions in place. In this case, it was the low income housing tax credits. We were covering all of the energy credits. So be aware, there is a FASB proposal that has been put into place. And I gave you the link to that. You'll be getting this presentation after we receive the surveys. So that gives us our next keyword, another keyword, which is sustainability. I know it's a long one, but we talk a lot about it with this new legislation, sustainability. Also, we talk about ESG, which is your environmental, social, and governance. Okay. So there are sustainability professionals. There are climate activists, as we know, and there are economists in this area. And they're together are calling the legislation under the Inflation Reduction Act as the biggest climate legislation, because we did see 370 billion of subsidies and tax credits into the electric vehicle area, the renewable energy area, the carbon capture area, and storage area, right? And what is the effect of this? They're hoping to project, as we said, to reduce total US greenhouse gas emissions by 40% by 2030. And I provide you the link to some of those articles and green groups there. All right. So remember, our word is sustainability. You'll see later that the SEC has some proposals that they have in place for the public companies. And so please jot that down because we're going to be going to our next slide. This is slide 69. What about the Inflation Reduction Act, ESG, and sustainability? Well, there's funding for high carbon industries. In those areas, we're not going to go over this in detail. I just want you to be aware of it. There's a 45Q tax credit and funding for what's called GHG emissions reporting, which is by the Environmental Protection Agency, and aligning in new rules in the Security and Exchange Commission's climate proposal. All links that I provide you in this handout when we send it to you. And so sustainability is a big area.
When you get a chance, come in. Something
Okay.
urgent.
We're continuing, and if you can just mute. And again, you have grants for climate resilience and adaptation. Why are we doing this? It's to reduce carbon emissions. So it's not only a tax act, but it's helping to reduce carbon emissions projected in the future. Provisions could generate enormous public health and job benefits, according to the studies, preventing illnesses and premature deaths. They have some numbers listed here, 3,900 premature deaths from air pollution in 2030. And in addition, up to 900,000 of avoided asthma attacks and avoided lost work days, which they could be believed to be anywhere from 405,000 to 417,000. All right, so that's your sustainability background. And of course, we know it's a 10-year plan of tax incentives that we're going to see using the Internal Revenue Code to incentivize this, as we have been dissecting all along. So the incentives is focusing on your residential rooftop solar systems that we talked about, your heat pumps, small wind energy systems, and the sourcing of domestically manufactured steel, iron, and other products. Again, final assembly is the North America area. So what is the impact of the Inflation Reduction Act on financial statement presentation and CFOs? Well, we talked about that there's going to be a book minimum tax. In addition, the FASB accounting standards codification, ASC 740, brings up about uncertain tax positions and in those financial statements, and provides that the applicable tax rate for measuring U.S. federal deferred tax is the regular tax rate, because there has been a lot of discussion in this area. Therefore, companies will not have to remeasure deferred taxes in the quarterly period of enactment, all right, which was in August of 2022. So there's a lot of that pushback going on. There's a lot of discussion with regards to the excise taxes and the quarterlies. The excise tax that these companies are paying, that we talked about earlier, are not deductible. And that's why we think we're going to see more of a dividend push to the shareholders. All right. Now, we go back to the impact of the legislation on the Internal Revenue Code. And these are sections from the Internal Revenue Code. They're creating a new 5-year maker's property. Under section 4611 small f2, provides there's an increase and a reinstatement in hazardous substance superfund taxes. So we're going to see that on oil and petroleum products. And those are going to be effective annually, January 1st, 2023. And then the maker property, 5-year property, is extended to certain green energy property. And it's going to provide this 5-year property for the automobiles that we were talking about under the Inflation Reduction Act. And there's going to be 3 categories of green energy property under section 168E3 large P, under this 5-year property. Here's your list of green property. They're going to be known as, now remember, 2023, qualified facilities, a facility defined under section 45YB1A for the new clean electricity production credit, qualified property, which is going to be certain property defined under section 48 large EB2 for the new clean electricity investment credit, which is a qualified investment. And C, energy storage technology. This is another property defined under section 48C6 for the energy credit, but without application of the termination date for that provision. So we have various new properties, green properties under the 5-year property. And so those you should be aware of, and those have been adopted. This talks about more of the coal excise tax. I'm not going to go into this in detail, but you should know it's under section 4112. That has been extended since the date of enactment. And also, as we said, the Superfund taxes on crude oil and petroleum products. You can read more about that at your leisure, and that's effective January 1st, 2023. Okay, and this is more about the super funds, but you can keep an eye on Washington with regards to that, because I don't think many of us get involved in that. But with regards to the Infrastructure Investment and Jobs Act, which is HR 3684, now this isn't different than the Inflation Reduction Act. Remember, the Infrastructure Act was passed November of 2021. The Inflation Reduction Act was passed in August of 2022. The big thing with regards to practitioners for the Infrastructure Act is the act includes a provision that amends the IRC section 6045 to expand information reporting regarding crypto. So we're going to see, tracking of basis to include brokers or any person who is responsible for regularly providing any service transfers of digital assets, which of course includes the crypto, on behalf of another person. So of course, yes would be the answer. If we're selling and we're getting a gain, then we say yes to our 1040 question that we're involved with the crypto area. And then of course, basis is going to be tracked for us. And this would make reporting, of course, similar than when we reported way back when I did presentations, when you had stocks basis being reported in 2000 as of 2011 and mutual funds as of 2012. Now we have the crypto reports. Okay, so that's an area that we're going to get more and more as we prepare returns. And in addition, you may see more forms 8938, which is a statement of specified foreign financial assets. If your client has more than 150,000 in assets that are crypto and may be held in another country, okay? You may have to start reporting that. And then, of course, FinCEN got involved with regards to the FBAR, or what is known as the Foreign Bank and Financial Accounts regulations, to define what a foreign holding with regards to a hot wallet or a cold wallet. And a cold wallet could be, which is offline, holding crypto, could be considered a foreign asset if held in a different country. So a lot of this is merging all together with regards to crypto compliance, and we're seeing this. So in the Infrastructure Act of 2021, it defined a digital asset as property. It's not subject to the wash sale right now because there is challenges going on. Is crypto a security? Is crypto a commodity? It's not defined as a security at this point, so it's not subject to the wash sale, but it is subject to reporting. So the definition is property. So if you're holding crypto and you sell it and you have a capital gain, then you will report your capital gain. If you have capital losses, you're going to offset it. And then, of course, harvesting subject to up to $3,000 off any other income, but you're not going to have to worry about the wash sale at this point. If you're receiving crypto as income, it's the fair market value upon receipt. If it's subject to wages, you're going to have FICA, you're going to have FUTA, just like you do on any wages. You're going to recognize gain or loss on a property, sale of that crypto, of course. And let me just see if I can get you up to that other point there that I wanted to make. And it's long-term if held for 1 year and a day, and short-term if held for less. Okay. In addition to the Infrastructure Act, another revenue raiser was to terminate the employee retention credit. And so The employee retention credit was implemented as part of the CARES Act, of course, in response to COVID-19. And that was with employee costs and extended in pre-act law through December 31st, 2021. And then that had stopped and been terminated for wages paid before October 1st of 2021, unless, of course, you're a recovery startup business that began operations after February 15, 2020, and had annual gross receipts under $1 million, are still eligible for the last quarter of 2021. So it was stopped September 30, 21. It was supposed to be to December 31st, 21. But for your recovery startups, it was left to the fourth quarter. Also, as practitioners, we want to be wary of third parties promoting the employee retention credit. And IRS warns us of this and reminds that taxpayers are responsible for the information that they provide on the returns, of course, requesting credits. More than likely, those are going to be audited in this area. And so as the practitioner, you want to have the right documentation in place. And also, if you're using a third-party provider, a specialist in this area, you want to vet them and make sure that you agree with their calculations. This one I'm not going to cover in detail. It came out of the Infrastructure Act. It was about what's called pension smoothing, and it was just a revenue raiser area and really doesn't apply to us, but about $3 billion is estimated to raise revenue in this area over a 10-year period. And it had to do with the level of reducing deductible employer pension contributions. All right. Now, we covered oral energy. I promised that I would talk about Form 7203, which is your S corporation basis. And so that brings us to our next word. So we had sustainability, and now we have basis. Now we have basis, and that's Form 7203. You should have experienced this form in 2021. You couldn't e-file, you shouldn't have e-filed the return. Actually, it would allow you to e-file, but you should have attached 7203. And we're going to talk about when you need the 7203. But what I'm finding is that you should just be preparing the 7203 each year, even if it doesn't need to be attached to the return because of loss limitations. Because when you do need it, you want to make sure that basis carryover with stock and debt is correct. And when you start that form, you want to make sure the prior carryover basis in starting that form is also correct, because you don't want to perpetuate an error in Circular 230, under Circular 230 practitioners. So why did the IRS introduce the Form 7203 for basis purposes in an S corp? Well, the IRS found that shareholders claimed losses and deductions to which they were not entitled, okay, that they felt that they were not entitled when they did a study. Because the shareholder didn't have sufficient stock or debt basis to take the loss. And what happens is then you're going to have this negative in the AAA account when you look at the tax return and right below the balance sheet. And if that business closes, that negative number technically can be recognized as a capital gain. And so this wasn't happening, and things were being zeroed out, and people were taking losses and they weren't getting limitations. Now, practitioners who prepare the actual S corp return are required to track the debt basis, and we're going to see that. I always try to track both for the closely held shareholder, so they would have that information. But it's really the shareholder who's required to track their basis and report their basis. And it started in 2021, as we said. The form assists the shareholder in calculating and reporting their stock and debt basis. And generally, the deduction for the allocation of aggregation of loss and deduction items on their K1 based on their stock and loan basis in the corporation, okay? And this is a 3-part form, and there are worksheets that are provided in that form. And of course, it was started in 2021, and it's continuing going forward. Who must file the Form 7203? And of course, that's S corporation shareholders. And we have three to four scenarios here, okay? Claiming a deduction for their share of an aggregate loss from an S corp, including an aggregate loss not allowed last year because of limitations. So you're carrying it over, right? So that if we're claiming a loss or a carryover loss, we need the Form 7203. If we received a non-dividend distribution from an S Corp, you need the 7203. If you disposed of stock in an S corporation, whether or not a gain or loss is recognized, you need a 7203. And if you received a loan repayment from an S Corp, again, we need the 7203 attached to the individual shareholder's return. So as I said earlier, if the form is not required, you should still be tracking it and retaining it in the practitioner's records, in the taxpayer's records. Of course, it's the shareholder's responsibility to track, and it should be in your engagement letters now. Now that we have to do and help and assist in this tracking and prepare these forms, this should be part of a specific item in your engagement letter. Basis is generally figured at the end of the year. And that as such, we will then attach the Form 7203 to a paper or an e-filed return. So part one of the 7203 is your shareholder stock basis. And if you're calculating, you must calculate from the initial basis in the S Corp stock, and that depends on how the shareholder acquired it. If the shareholders, if the shares purchased were outright, the initial basis is the cost of the shares, of course. And then once that shareholder basis is established, it must be adjusted accordingly as you go along. And of course, it looks at when a shareholder buys or sells stock in the corp or contributes capital to the corporation. And more than likely, it would be adjusted each year by various items of the corporate income loss and deductions and distributions to the shareholder, which you recognize on the Schedule K1. And as I said, even if the shareholder's calculated basis is incorrect in a year for which the statute of limitation has expired, you actually have to go back and make sure that that calculation that you're carrying forward is accurate. Part two, shareholder debt basis. You're going to record the stock basis, and it cannot be reduced below zero. That's in accordance with IRC section 13679 A2. And once that basis has been reduced to zero, of course, pass-through losses and deductions still can be deducted to the extent that the shareholder has debt basis. And that's in part two. That is basis in a bona fide direct loan from the shareholder to the S Corp. And it's also defined under regulation 1.1366-2A211. A lot of legislation here. The debt basis is part two on your Form 7203. And again, is completed if the shareholder has, and that was number 4 on the bottom, has personally loaned money to the corporation. And each loan must be documented, must be a bona fide note made to the corporation, to that S Corp, and it must be tracked separately in each column. So you're going to have multiple loans, cannot be aggregated. And if the shareholder has more than 3, you're going to need additional pages. So let's look at part 3, shareholder allowable loss and deduction items. That's part 3 of 7203. It identifies the allowable loss and deduction items that may be taken on a taxpayer's 1040. So if you have corporate losses and items limited to the sum of stock and debt basis, part 3 is used to calculate whether a loss is allowed. All right. So I thought it would be important to go over what IRS has been providing, and I've been talking about for quite a few years, creating a written information security plan on what they're defining as WISP. And this is specifically focused for tax and accounting practices, although I think small businesses could take advantage of this, because the plan needs to be tailored to the size of the business anyway. And we have a lot of commonalities. The only problem is that in the tax and accounting practice and in other small businesses, you have a lot of PII or personally identifiable information. And you need to understand what the difference between PII and non-public information is. We are all subject to the Graham-Leach-Bliley Act, okay, the GBLA, Graham-Leach-Bliley Act. Graham Leach-Bliley Act, GLBA. And we are then covered under the FTC as a financial institution. So you can always go to ftc.gov and look up some of the major companies that have been hit with data breaches. And also, if you go to presentations with the IRS, with the stakeholder liaisons, or even IRS forums, they'll describe about practitioners who have been breached and what their experiences were, not good experiences, obviously. Each document that you hold, and we have millions of documents, averages about $200 in a breach. It could go quickly up to $250,000 cost in a breach. And that's why it's recommended that you have cybersecurity insurance, but it's also recommended that you have this written information security plan to help prevent the breaches from occurring. So these are just examples. I like to give examples in the beginning so you understand how it affects, how it could affect a practice or your everyday life. So in this example here, Verizon had a data breach investigative report, and it reported that 82% of breaches involve a human element. So all of us create the possibility or the inherent risk of a possibility of a breach coming in. And that could be from phishing, we know through emails, misuse of information, not intentionally, it just happens, misuse of what we're doing socially, social engineering, which we shouldn't be doing on our networking, or just plain errors. Somebody mails out an envelope with a USB drive, shouldn't be doing that, right? And it gets to the client and the USB drive, the envelope gets there, but the USB drive does not. Phishing, however, is one of the 4 main entry points into an organization. And the top 5 crime type on the list of internet crime complaints, which is managed by the IC3, which is the that center that focuses on this and studies this, is phishing, vishing, smishing, and farming. Now, all of these have to do with either they're going through your computer, they're going through your cell phone, they're also contacting you on the telephone to ask you for information. Phishing is the most common because it comes through an email. And usually you'll have that human element, that person that's sitting there reading the email who will act fast and then click on either the email. Sometimes an email could create just a spoof, and we'll talk about that, or a link. You click on a link. So you have to watch out when you hover on these links. The common schemes, the most common schemes that target tax professionals are spear phishing, meaning it's coming to you either impersonating the IRS, the tax software provider you use, or someone that you're familiar with. Ransomware, where it's locking down your system. And then, of course, unauthorized access, which happens a lot over the weekends. You'll see that either through a link that maybe you've clicked on. There was an instance with a practitioner where she got an invoice from QuickBooks. It didn't say the things it should. It said that her invoice was outstanding, and so she clicked on it, and that was at like a Friday. And then over the weekend, when she came in, some of her returns were already filed, and the routing and account numbers were changed. So, when they talk about check your routing and account numbers on these returns, you should do it. Just don't do it in a batch, because then you'll be able to identify if there was some kind of breach. The phishing life cycle of an email comes in 3-pronged. Usually the lure, where they are enticing email content to you. There's an urgent message to do something. The hook, where there's the phishing URL that you click on, which you should hover over, or a malicious attachment. A lot of times, prospective clients, I'm going to show an example of that, new client email, where they'll say, I'm a new client, I would like to hire you or retain you, and they have a PDF attached to their email. The catch is the transaction conducted by that perpetrator following the successful attempt. So what they do after that, once they give you the bait and you take it. Okay. There's been a lot of IRS themed phishing emails that IRS wants you to be aware of with regards to the economic impact payments. In this particular memo or email, it stated that they did an annual calculation, which IRS was not sending these out to determine that the taxpayer was eligible for a payment of $532, and this had to do with COVID. And of course, they have a hyperlink. Let's get started. The person does it, and there you go. They get their information. It could be social security numbers, of course, names and addresses, bank account information, etc. Okay, spear phishing targets a specific audience. So it could be someone that you think is your fellow tax practitioner, a tax software provider, or a potential or current client. The goal is to convince you to open an URL or download an attachment. And that's when you're going to be doing that, you want to stop, okay? Because generally we should be using portals anyway. So you don't want clients sending you attached information so that you think you need to click on it. And a lot of times if that does happen, either the client will alert you ahead of time and you tell them not to do that, or a client has been spoofed. And sometimes their various services that they're using will get compromised and send you out a message. Common spear phishing since 2017, the email may have no grammatical mistakes anymore. We had said that there could be mistakes. That's not happening anymore. The perpetrators are getting aware of that, and they're making it look like it's an actual email. Stolen email credentials from someone you know, a new client scam. Whenever you see a new client email, don't go into it, because you would rather have that client contact you than email you, someone who you do not know. There's account takeovers, and then what's called business email compromises, or BECs, and business email spoofing, which is your best scam. So those are two types of things, where they hijack your account or they spoof the account. Okay, so this is an example of an email of a client describing their situation to you that you receive in your email. I'm hoping you're not at capacity. I'm willing to take on a new client. I have all my books and forms in place, etc. Please write back if you're open to tax clients and how to proceed. This is from the IRS providing you an excerpt of what practitioners have received. So do not answer these emails. The new client scam, second email. Hi, preparer, sorry for the late response. Things haven't been going good, etc., etc. Here is my attached 1040 scan copy. And that's coming from what looks like a secure SSL copy of a prior return. But in this case, this was not, and they were able to provide the malware once the click happened. So they're getting a lot more savvy these days. This is an example of an account takeover. Your account is on hold. It looks like it's coming from the IRS. And it states all tax preparers are required to apply a security feature into their new account. And you know, a lot of this comes from e-services as well. In other words, not e-services with IRS. It makes it look like it's coming from e-services. And so you click on it thinking that you have to update. You see at the bottom, sincerely irs.gov e-services. So be very careful, hover over the links. And then there's what's known as account on hold phishing website. So in other words, it looks like what we log into when we go into our tax software, but it's actually an impersonation of the login of our tax software, which also kind of leads me to question whether I should go totally into the cloud with my clients, because this can happen a lot. and as opposed to keeping client records on the server and then encrypting and backing up into the cloud. All right, so as we said, what is the business email compromise versus the business email spoof? Business email compromise is when they hijack an email account or an email server to intercept the business transactions and redirect your payments, or send spoofed email from an external account pretending to be a company executive authorizing irregular payment transactions or payroll transactions. And this is from Dell Secure Works. So it's happening a lot. And you have to be very savvy with regards to not jumping the gun when you answer these, because the types of activities they're looking to take over are direct deposit, employment, providing you fake invoices to send payments to through one of the social platforms, PayPal, Venmo, etc. Gift cards, and believe it or not, that's the most common with tax practitioner accounts. Title and escrow, wire transfers, of course. You never want to respond to a wire transfer that comes in an email, and of course the W-2 scam. And this just gives us an example of the urgent message on a direct deposit request. I want to update my new banking information before the next payroll. What details will you need, etc. And you respond to it, providing back and forth the details that they're requesting. The iTunes gift card for tax preparers, I don't even understand why a preparer would respond to an iTunes gift card request, but that's something that has been out there. And this is the W-2 scam example. A correspondence, kindly send me the W-2 copies and earning summaries for all employees from 2021 for a quick review, and it comes from the payroll department of the company. Somehow they figure out how to determine by compromising the email, impersonating that sender. And this is an example of an encryption of your computer system. Of course, you want to get off online quickly, unplug your computers, contact your IT persons, and then we'll tell you how to go with regards to disclosure. But this is all of the areas. This chart shows all of the ways a perpetrator can get through your system. If it's through a router, it could be through an iPad that has wireless. It could be through your cell phone, depending on what you're connected to. You want to disable Siri and Alexa apps on your phones. You don't want to use PII, personally identifiable information, when you're using those. And also your printers and any wireless devices have default passwords, which you need to change because they could get access to your system from there. And so IRS asks that you deploy in your written information security plan the Security 6 protections. And what do we have? Our first word for this section, which is security. Okay, it's in red. It makes sense. We're trying to develop a written information security plan. So the 6 security protections are your 1, antivirus software must be updated continuously. Firewalls, not only on your computers, your workstations, your servers, and your routers, as well as 2-factor authentication. Now you're going to see that a lot on the software. Most software providers are requiring that. Backup software services. You could do a backup drive, data drive into the cloud, and your information must get encrypted before it goes into the cloud. And the Federal Trade Commission is looking for encryption on standing information. That's the next thing they're looking to pass. So while your information, that PII, is sitting in your computer, they would like that to be encrypted as well. It does make the system slower. So that's drive encryption. And then, of course, virtual private networks, where if you have a remote worker, especially during the pandemic, they're using a VPN to get into your system. There are cases where VPNs could be compromised. You want to make sure that you don't keep on auto runs and also logins that are remote, because these perpetrators can use them. And as I said before, generally over the weekend. So what are signs of client data theft. You need to be aware of that, and your employees need to be aware of that. If client e-file returns begin to reject, now we know we had a couple of those, and the client themselves could get compromised. So even if you have a reject, that doesn't mean that there's been a compromise, but of course, now you're going to keep an eye on it. Clients who haven't filed tax returns begin to receive authentication notices and letters 5071C, 4883C, 5747C from the IRS. Now, they could get these notices even without a compromise, because if they change preparers or they have a large refund or they change their address, they may get these notices. You just have to be savvy to the situation and assess it as you're going along. Clients who haven't filed tax returns receive refunds. That's another one. Your software was compromised with a bot. This is what I was talking about earlier, changing the routing and bank account info. Of course, always check before e-filing the routing and bank account information. They say at least 3 times. Try not to pay a ransom, and you're going to work with your IT provider and your cybersecurity carrier if a violation has occurred, if a breach has occurred. More than likely, you're going to also retain legal counsel in that area. More signs of client data theft. Clients, practitioners receive tax transcripts that they did not request. Tax transcripts that they did not request. Clients who created an IRS online services account are notified that their account was accessed and disabled. So, this is all about using e-services and using online transcripts. Those are getting hacked as well. So you have to watch out for that. Watch with irs.gov, watch for the newsroom information. But just make sure that if you see that people are getting tax transcripts and you did not request them, then obviously something is going awry. Sometimes they do request them and they don't realize they did request them. So you have to assess each situation. Another variation is clients receive notices with an account that was created in their names. Okay, that's hopefully does not happen, but that's been one of the theft situations. So what happens? What do we do if we get a phishing email? Well, they would like you to make a PDF of it and send it to phishing@irs.gov. And they're tracking them and they're alerting various agencies, FTC, etc. Paper file returns. If you're in an instance where you're in a reporting mechanism because there was a breach, when you paper file the return and you want to do it at the instruction of the IRS stakeholder liaison, the paper filed returns generally will then override the e-filed returns in this case. You're going to also have to work on an identity theft affidavit for each person, which is a form 14039, and form 15227, which is your application for identity theft protection for each client. And the sounding board is the IRS stakeholder liaison, which generally you have 24 hours to contact when there is a breach. Of course, I would suggest simultaneously contacting the attorney and your attorney in this area and the insurance company. You're going to end up needing a forensic IT. That should be separate from your IT provider. I mean, I have an IT networker for the office, as well as a cybersecurity person. You would need then a forensics person who would be independent of those. And those can also do penetration testing when we talk about your written information security plan. Draft the client letter with the attorney, and then the client will send the executed forms 14039 and 15227. And then, of course, keep on top of your PTIN and EFIN accounts with regards to information or returns that are being filed more than are on the accounts. You can also text at 7727 to your provider for SMS fraud text messages that you have received. Okay, let's get into the plan because we only have about 15 minutes or 18 minutes or so. The WISP, the Written Information Security Plan, should be a combination of all research. And as I said, the Graham-Leach-Bliley Act, or GLBA, has been around since the 1990s. Okay, so that gave implementation to the Federal Trade Commission to issue the safeguards rule and the safeguard disposal rule. And so you can go to ftc.gov and learn all about these rules and use some of that information, okay? But what you want to do first is to identify a designated employee, and that's going to be your data security officer in the firm. If you're a sole practitioner, it's going to be yourself. But you're also going to need someone who's a PR person as well. If there was a breach, that would be a separate person, okay? And that person who's designated is the one who's going to be in charge of the written information security plan. And so you're going to identify and assess the risks of the company's operations. You're going to do an organizational chart showing where PII information runs through your business and the users as well as the hardware components. And you're going to design and implement safeguards. This is like an internal control document. And you'll notice that in here, there's going to be suggestion to use the form 4557, that publication. That's taxpayer safeguarding data outline information from the IRS. It's kind of incorporated in the written information security plan, right? And then you're going to test it as you go along. And if there's any weaknesses, you will identify them. And then you will correct them, make recommendations, document it, and then adjust your written information security plan. Now, as I said, IRS has publication 4557, Safeguarding Taxpayer Data, and FTC Data Breach Response Guide. And of course, in your security plan, you want to have continual employee management and training. You're going to circulate that through the office. You want to know where your information systems are and the priority of information that can be disclosed and what the penalties are, and detecting and managing system failures. And of course, for your independent contractors, you want to make sure those are subject to the same laws that your office is subject to. If it's New York State, whatever those regulations are with regards to cybersecurity, and also should be covered under the Federal Trade Commission. If they're out of the country, no good to use, but you should have an agreement with them. Okay, the identifying of that responsible person is the person who will coordinate the security program, as well as other responsible persons if you have a multi-member firm, and you want to list authorized users of your firm, the data that they have access to, and the responsibilities on a need-to-know basis. In other words, they shouldn't have access to everything, okay? This is your internal control document. They should only have it on a need-to-know basis, and you should need to know, you should have listed also their passwords and when they're actually using hardware, and we'll show you that later. You can also have potential areas of data loss internally and externally. You can look at open ports. You could look at auto runs. And again, these will be tested for penetration testing. Later, I'm going to provide you very quickly as I go through this, worksheets for your inventory hardware and your document safety measures that you should have in place with regards to collecting PII, disclosing data. Remember, we had talked about many times use and disclosure of taxpayer information. You are the protector of that information. Your network protection, your electronic data exchange, your Wi-Fi should be W2 Wi-Fi at the highest level, and make sure those remote access programs are closed when possible. And reportable incidents we discussed. So how do we implement? Here is an actual front page of the written information security plan where you're going to put the name of your firm. And it's for only distribution in your office and training in your office. Okay. And so what it's going to cover is what information is considered PII, or personally identifiable information. Social security numbers, date of births, employment data. That's your own internal payroll. Driver's license numbers, state issued identification number cards, income data, tax filings, income statements are PII. Retirement plan data, and when you're going back and forth from being a financial advisor to a tax practitioner, again, you must have different consents in place. And if that information shouldn't be on the system, such as medical information, because then you would be subject to HIPAA. You should then purge that information, and you should purge it in a protected mode, right? You can use an independent company that comes in, that you vet, to come in and take your information to shred or purge. Now, email addresses, non-listed phone numbers, residential and mobile or contact information that is not published is also considered PII, as well as financial account numbers, credit cards or debit card numbers, and all the information that goes with that. And of course, if you're using credit cards, you're going to have a compliance that's generally due annually that you have to meet. Okay, so who are the responsible persons? So you're going to have the firm name, and then you're going to have the designated person, the data security officer or the data security coordinator, depending on how your firm is set up. That responsible person is the official of the firm who's going to implement the written information security plan and all its protocols, who are going to identify all the firm's repositories of data and where they're going and what the protocols are. They're going to verify all employees have completed their recurring information security plan training, monitoring and testing employees. You can do ad hocs. You could have penetration into those employees by a separate provider that comes in and is familiar in the cyber area to test them to see if they fall for these BECs or these BESs that I was talking about, these email compromises. Evaluating the ability of any third-party service provider. All the independent contractors, they're going to look at the agreements to see if they have security provisions in them. Requiring third-party service providers to implement and maintain appropriate security measures, and reviewing the scope of the measures in the written information security plan, identifying the risks, and then recommending the internal controls, and they will provide the annual training to the office. Also, it'll talk about client communications and how you would communicate to the outside. And this person is known as the public information officer. Now, it could be in a sole practitioner firm, it could be that one person, that one point person, the owner, or they can bring in another person to work that area for compliance and quality control. But it's known as a public information officer, PIO, and they deal with all client communications by phone, conversation, or in writing. They could determine if there's a wire from them or a PDF, etc. All statements to law enforcement agencies if there is a breach, all releases to news media, and all information released to business associates, neighboring businesses, and trade associations. That's to help to form the PR of the firm. In addition, your firm should have a retention policy, right? It's not part of the written information security plan as part, in other words, it's attached to it. It's a separate document that should be referred to in the written information security plan. In that, we're only collecting the PII that is needed and necessary and is only being shared with information in our office on a need-to-know basis. And of course, access to that information should be limited on a job-to-job basis. And the data security coordinator will identify and document the locations where this PII can be located, such as servers, disk drives, filing cabinets, of course, should be locked, PC workstations, online applications, databases, such as bookkeeping and tax software, and other types of removable drives. So you have to watch out for it. And any new drives or software should be passed to the DSC. You should also have a designated written and electronic records containing PII shall be destroyed or deleted at the earliest opportunity with regards to the retention policy and to a provider who has secure measures to do so, and follow the FTC disposal rule. Okay, all employees are responsible for maintaining the privacy and integrity of the firms retained. When you get new employees, you can actually do background checks. However, each state has a different provision for that. So when you're communicating, whether you're going to retain an employee or not, you have to follow the state's regulations in this areas. Any employee who willfully discloses PII or fails to comply with policies will face immediate disciplinary action. Or you want to tell them about warnings, written warnings, verbal warnings, and eventually termination. If these individuals are terminated, they should then be taken off the list of authorized users. And you should have access to all their information and passwords. Passwords should be maintained in a password manager and should be 12 or more and complex. Terminated employees' computer access logins and passwords will be disabled upon their termination. And in addition, in the written information security plan, you will have a PII disclosure policy. A PII disclosure policy. And that's our second word. We're getting there. Security is the first one. Disclosure is the second. Jot that down. Disclosure in this area. No PII will be disclosed without authenticating the receiving party and without securing written authorization from the individual whose PII is contained in such disclosure. And so that goes back to the taxpayer consent and use that the IRS requires to have on file. So if you're a financial advisor or you have a financial advisory firm in your office and you're going to share that information, you must have written authorization for that. And that can't be paid for. You have to generally do that every tax season and have that part of your documents. All right, generally, if someone wants me to contact a loan officer, which I generally don't like to do, I will have to have that consent of disclosure on file. The DSC will also notify the IRS stakeholder liaison if there's a breach and all other agencies that are required if there is an incident. So they're pretty much responsible for this document. And networking protections and policies. Access, as we said before, Wi-Fi access should be two-factor authentication to FA, and tax software access should be that as well as other access of software in your firm. The wireless access policy as well. Where are they being accessed? Is there strong encryption? And do you require a password? And do you have a guest access that's off the network? Because you want to make sure it's not part of the same network. Also be aware that remote access from a breach generally occurs at nights and weekends and are high threat periods for remote access takeover. So you close for the weekend, your workstations either were left on or your servers on. There is a breach, gets it all ready over the weekend. And then when Monday comes, whatever that type of breach that they're going to do, which they stay dormant, they will send in the returns at that time in regular business hours so it doesn't look strange and you won't catch it. Any new devices also must be known about to connect to the internal network, all right? And there should be security patches on everything. So you'll see there's a connected device policy, there's an information security training policy for all employees that they must sign off, and the date of implementation for this written information security plan must be signed by the principal operating officer and the data security coordinator. All right, and the date of implementation, and then you're going to test from there. So just to reiterate, you have to identify your responsible individuals, assess risks, inventory your hardware, and we're going to get to those sheets really quickly, document safety measures, and how you do data collection and retention, all security software, antivirus, anti-malware, anti-tracker, and similar protections, monitor all computer systems for unauthorized access. When you're meeting with your IT, look at the logs and routine review. If it's not daily, then monthly, weekly, however often you work, and remote access and how employees are going to work through the VPN securely. Also, do not have after business hours remote access to your network. Historically, this is prime time for hackers, all right? And if those are left open, then that gives them an opening to your system. Let's just make sure we didn't miss something here. Reportable incidents, we went through that, the report notification, and of course, you're going to have an employee code of conduct when it comes to PII. All right, what ancillary attachments do we need? We said we're going to use publication 4557, which talks about security breach notifications procedures. and your record retention policy. You should have that as part of it. That's attachment number 1. Attachment number 2, rules of behavior and conduct of safeguarding client PII. That should be done at the beginning of a new tax season cycle and revisit it. You could go to sans.org to get more resources on this. Sample attachment C, security breach procedures and notifications. D, employee contract acknowledgements of understanding. And the best practice in this area is it's important that employees see the owners and managers put themselves under the same rules as everyone else. That's tone at the top, right? Tone at the top. Firm hardware inventory containing PII data. And so this ensures that your devices will be secure and you're on top of them, and that employees only have access on a need-to-know basis. And of course, you're going to track an employee's rights that get increased or decreased if they're part-time, if they're independents, etc. There's going to be a worksheet for that. And the rules of behavior should be distributed. That's actually in that NIST manual, which is 7621 Small Business Information Security, the Fundamentals, Section 4. Be careful of email attachments, as we talked about. Use separate personal and business computers, mobile devices, and email accounts. That should be for personal use. Do not connect to the network. Okay. And again, we talked about all of this. This is a sample attachment of security breach procedures and notifications, and how you should be working with the IRS stakeholder liaison, monitoring your PTINs, monitoring your EFINs activity. Also, 2848s, your CAF numbers should be terminated if you're not working with a client any longer. And also, the FTC provides information compromise and the risk of identity theft guidance for your business. There's a link for that as well. Okay. So our
Doreen?
we're going to do our last keyword.
You have 2 more keywords.
Okay, I'm going to
and
give you.
You have a number of questions.
Okay, the last key, well, the third keyword is employee that you see here. Employee contractor acknowledgement of understanding. Okay, employee is the last keyword. The last of 3, and then I'll give you a bonus if you're still on. Okay, if you didn't get the first set of 3, 3, and 3.
Do look to wrap up because I have half
Yeah.
a dozen questions here.
Okay, and if you notice here, this one I think is really important. It's about inventorying your firm hardware that contains the PII. And really what they want you to do with this is list the hardware and prioritize it. If PII was exposed, what would be the worst scenario in that case if that PII is exposed? And then you would do that in chronological order down. So the highest to the lowest, right? That's your hardware. And then you have firm employee authorized access. And if you notice, you have date access granted, date access terminated. And of course, we have a glossary of terms, which we generally have. One thing out of all the terms here, I don't think you know what out of stream is. That relates to the forwarding of a password for a file via a different mode of communication. So in other words, if you have to use a file in an email and you don't have an encrypted system and you put your password on it, and it better be strong, it should be 12 or more, you want to send to the client the password in a different format than when you sent the actual document in. And that's what out of stream means. Okay, so with that, let me give you your, one last thing. I always ask this question, and you just asked it recently. Do you have a privacy policy? You should have a privacy policy in your office that explains the access of information between your firm, and that's permitted and doesn't need a use and disclosure form, but also the difference between an accountant and a practitioner and a lawyer's privilege. Okay, we could get subpoenaed. They can't. They have privilege. If you need to work up with a client that has some criminal matters, you want to be hired by the attorney for the privileged information there, okay? Because we could get subpoenaed. And also there's a publication 4524, which helps for you to communicate to the client and I have this in the resources here, how best they should run their own data, because sometimes it gets mingled with sending it to us. And if they get compromised, then you should recommend to them to get an identity theft protection PIN. Tell them they should avoid any phishing scams, because then all of a sudden they're going to pull you into it. And they should understand also the identity theft situation with regards to taxpayer data. Okay, with that, I'll answer your questions. Let me just see if there's anything else here
Okay.
I can provide for you.
Frank wanted to know what you're sending out. That's going to include a template for a written plan, right?
Yes, so I have here the announcement of the written information security plan, and right here, and you could actually jot it down, it's publication 5708. 5708. That's the
5708.
sample of the plan. You could take that, but they want you to tailor it to your firm.
Okay. John
Doreen, you're
LaGuardia.
actually including it here, and it's a link to get the plan. We're not
Correct.
sending the plan.
So this is the template of it, or explaining how you should do it and the components. And then there's a link that they provide to an example of a written information security plan that they could put the name of their firm on, but they need to tweak for the size of it.
To be specific.
Yeah, there's
Okay.
worksheets, right? So you need to talk about the hardware. You need to talk about access to that information, who has access, where it is. Everyone's firm is different.
Okay. Roy is asking, which I believe the answer is very simple. Do we need this for sole person practice? If yes, is there a simple outline?
You do need it, and you could go directly to publication 5708 and also publication 4557. And there's not a sole practitioner, let's put it this way, publication. It's just they provide you the minimums that you need, and then you take it and use that document to compile the internal controls that you need.
Okay. Give me 1 second here. John LaGuardia said, thanks. Frank's asking, what is drive encryption? Let you try and explain.
Well, drive encryption is when your data that's sitting in your workstation, your server, gets encrypted, right? So that it can't be read by an outside party if they try to access it.
Okay, let me keep going. What else do we have here? Frank mentioned having LikeLock is a really good idea to find out if you're on the dark web.
Uh-huh.
And then I'll go back with a couple of questions to prior stuff. Larry wanted to know, were ERCs limited to clients with gross receipts under 1 million per year?
Going back to the employee retention credit?
Yes.
I'm sorry, what was that question?
One more second. Where was I? Were ERCs limited to clients with gross receipts under 1 million per year?
No. No, that we were talking about the termination of the ERC, and that the startup recovery businesses were able to go from the third quarter to the fourth quarter of 2021. That was the only limitation that I saw there. Now, remember, the ERC went through various years, 20, 21, 22, and there was different government orders that you have to look at. And also there were different provisions during the years. So, you know, he might be referring to the under 5 million, the under 1 million is for your startup recoveries at the time when they were doing the employee retention credit, and they didn't start yet. They hadn't started yet. They say they used that cutoff of February 15, 2020. And then they went into the March and they were going to start their business. And then the pandemic came, and it was March 13th, I think, of 2020, where we had to draw the line in the sand and shelter. That's where I think he's coming up with that $1 million threshold with regards to the startups. That's just startups.
Okay.
All right, I think at this point, we have to just come to an end.
Okay, is there any significant questions with regards to the WISP?
I don't think so.
Okay, so I'm gonna give my bonus keyword. And it's not a word. It's like the first one I started out with, which was an acronym, IRS. The bonus is WISP. We just talked about the WISP,
Gotcha.
okay?
John, is there a way that I can get a copy of the questions and the ones we answered?
I don't believe so.
All right.
And let me.
Okay, let's just move on. Doreen, could you just get me to the last slide, please?
Yes.
And while you're doing that, I'm going to take my moment. Again, I want to thank everybody that was on. It must have been really riveting because I don't think I've ever seen everybody stay on for the entire 3 hours. Nobody logged off before 12 o'clock. So that's quite amazing. Number two, I want to again thank John for giving us the opportunity to work with him and SCORE over these last, I've lost count how many years, but it's always a pleasure. They've been a tremendous help. Hopefully we've been the same and we'll continue working in the future. And John, wish you and your staff very happy holiday and a happy and healthy new year. Doreen, again, thank you very much.
You're welcome and happy
You
holidays.
always go above and beyond. I can't say any more. And the same to you and your family for a happy holiday and a happy healthy new year. Real quick, for the IAA, January 17th, we're going to have Warren Bergstein and Jack Gold do their annual update. I'm sure there'll be more, things that come up between now and then. You'll be getting a notice. It'll be either at 6 or 6:30. We're going to start it in the evening. My contact is liaranger@aol.com or 718-948-3008 or 917-608-2785. And that really is everything I've got. Thank you, everybody, for attending. And of course, wishing everybody a happy holiday season and a happy and healthy new year. And we do intend to be meeting in person somewhere next year. We'll do online, but we're going to meet in person.
Okay, John.
Thank you all. Thank you all for attending. Thank you so much, Doreen. I know there's a lot of information here.
Yes.
What you have between those two ears of yours, boy, let me tell you, we could sure use.
You're welcome.
Doreen is always available. She doesn't, if you need to reach her and ask her something, but as far as SCORE is concerned, we're here to help you if you need the help. And if you don't want to get to Doreen directly, you could get to us. You can get to her through SCORE, and we'll be glad to create the contact. With that, I think we've spent enough of time online here. So everyone have a good, safe, and healthy new year.